And of course, if you're not already following, we put loads of updates and stuff on Instagram, so harbour.jeremy on Instagram. There's a Harbour Club YouTube channel where we're posting tons and tons of new content at the moment. So if you go onto YouTube and search Harbour Club and subscribe there, that's highly recommended. If you just want nonsense, then Twitter's always a good option, which is Jeremy J. Harbour. And of course, connect on LinkedIn as well. We publish different content on all of the different social channels. So we're always giving away lots of interesting stuff. I think like this, I can actually share my video. Oh no, I am restricted from sharing my video.
Yeah, so was I.
Okay.
Now.
There we go. So I'm holding up two books that everyone can see. One of them is, no, I'm not really. Yeah, I thought I'll hand over to Callum now to walk you through some of the ideas around entrepreneurial investing, and then, like I say, we'll open it up to Q&As for the balance of the time we have available. So, Callum, hi, how are things?
Hey, good. Can everyone hear me all right? I've had a few technical problems today, but give me a thumbs up or something if you can hear me. Yep. Good. Okay, let's get kicked off then with back to where we were. So yeah, thank you all very much for joining. I will try and keep this fairly sharp paced. And so basically what we're going to cover off today is, there we go. So I'll do the presentation. I'm going to talk through 7 investing obstacles that we come across, and basically how you can, well, first of all, just be aware of those obstacles, and then how you can hopefully start to work around those. I'm going to put some of this in context of 4 historic trends, look at 3 optimum states, 1 course of action, and a partridge in a pear tree. And then we'll have a discussion, myself and Jeremy. Jeremy hasn't actually seen this presentation. Jeremy hasn't actually finished reading my book either, so we might be discussing that in the course of that. And then we'll open it up to Q&A. So stick any questions in the chat box. Jeremy will be looking at those while I'm presenting, and we'll get through those. We should be wrapped up in an hour. So yeah, let's kick off. So if you don't know who I am, well, you're probably on the wrong webinar, but I've spent 20 years or more now building, growing. Oh, I'm just seeing a message saying you can't hear me. Is anyone else? That would be a problem.
Yeah, I think most of the messages are saying that they can. There's but Maria is struggling.
Okay,
So
all right.
might be at her end.
For those that can't, Jeremy could do sign language in the corner.
My video's not working. I am doing something.
Yeah.
I'm doing sign language
over here. Anyway, we'll crack on. So look, yeah, I spent 25 years building, starting, building, growing, selling businesses. Spent the last 10 years as an investor or more now, and spent the last 5 years taking companies public. I've taken 2 companies public with Jeremy, and really understanding that whole public markets space. And that's kind of given us, both myself and Jeremy, a fairly unique insight into things. So let's kick off with the 7 investing obstacles. And this is something that's become really apparent the more I delve into this world, the more apparent how unjust the whole setup is for the average investor. These are 7 things. We'll go through them one by one. Like I said, I'm going to go through this pretty quickly. We are recording this, so it'll be available on the Harbour Club YouTube channel afterwards if you want to go back through it. So let's start with track record. Fundamentally, the best deals come to people that have a track record of delivering. If you're in the distressed, I am, but Jeremy has a reputation globally for being the foremost thinker in this area. So he gets access to deals that the average person just would never get. In the last global financial crisis, Warren Buffett was getting access to deals that were basically no-lose deals. It was upside or amazing upside. But he was getting those deals because he had the track record. I wasn't getting those deals, but he was. So you've got to have a track record. When you're a public company and you do acquisitions, by default, you start to build that track record. The more deals you do, the more companies come to you. So if you look at a company like WPP that has done thousands of acquisitions in the marketing space, they continue to attract deals all the time because they have a track record for it. So the second one that's worth being aware of is network. And if you look at somebody like Tim Ferriss, so Tim Ferriss was an early stage investor in Facebook, in Twitter, in Uber, and not because he had a track record, not because he had any angel investing chops, but before he was famous for the 4-hour work week, he organized a conference in Silicon Valley, and he was in charge of booking the speakers, so the VCs, the top entrepreneurs. So he had an incredible network. That got amplified exponentially with the success of the 4-hour work week. And consequently, those companies that could have their choice of any investor went to Tim Ferriss because he had an incredible network. Again, most of us just don't have that network, therefore we don't get the deal. So if you can tap into somebody that already has a network, or if you can tap into a company with a network, that will give you the edge over starting to get these best deals. So this is one I see a lot, and I see this both, some of you may know, I work with the World Business Angel Investment Forum, even though I don't do any angel or early stage investing. But I do see a lot of angel investors rely on this hope strategy. So basically they hear a good story, there's a possibility that this company is going to be the next Uber, and so they back it. If you contrast that with more experienced angel investors, more experienced angel investors have lost a lot of money. So they don't tend to have a hope strategy. What they're looking at is risk minimization. And you see it again also with people that start investing on the stock market. They'll go into stocks hoping that those stocks are going to be successful, as opposed to looking at downside protection. Again, if you look at this from a company perspective, you want to put in place your investments in such a way that your downside is protected. So number 4 is herd followers, and this is, unfortunately, this is human nature. It's just laziness. We just don't have the time, the energy, or the resources to do all the due diligence that we should do, and so we tend to follow social proof. Everyone has, for the last 10 years, everyone has been in startups because startups are new and exciting and sexy, and Silicon Valley has promoted them well. Even within that, you have herds going into cryptocurrencies or Bitcoin or marijuana, it was last year. And basically what tends to happen is we hear about it, enough people start talking about it, we think, well, if they're getting involved, then maybe we should get involved. But by the time that we're getting involved, the smart money is already getting out. So we want to avoid that herd followers, and that means looking in places that other people aren't necessarily looking. Number 5 is not knowing the rules. And this is, again, is something that you see both in angel investing, for example, but also in the market. So a lot of people will go into microcap or small cap investing. They really don't understand the forces that are at play. If a hedge fund decides that they want to become an activist investor in that company, it's very easy for them to do that. And if you don't know the rules that they're playing by, you're going to lose out in that trade. With angel investors, I often see angel investors trying to do the right thing by the founder. And so they put in place these very nice founder-friendly terms, but they don't know the games that VCs are playing when VCs come along. So if that company is successful, go for another round of investing, those very terms that made you a fantastic angel investor for that founder are the same terms that are going to work against you when the VC comes in. They're playing a very different game. and you lose out. So got to know the rules. Number 6, lack capital. This is just the harsh reality. The best deals go to the people with the most capital and the ability to invest. So anyone that's been following Jeremy for any length of time will know about the private wealth opportunities that are available to high net worths. But even in that space, there's deals that we can get access to as high net worths that but there's deals that we don't get access to that are only available to the ultra high net worth. So above 50 million, there's a whole bunch of deals that private banks don't share with lowly high net worth individuals. And then again, there's another benchmark around 200 million. And then you've got the billionaires that also get deals that would never get offered to mere mortal high net worth. So the more capital you get access to, the better your deals, which is, if you're a PLC and you've got access to capital, you're going to get access to more deals. And number 7 is timing. And I think this is kind of quite prudent given what's going on in the markets. It's nearly impossible to try and figure out timing. There's just so much, there's so many variables, and it really, anyone that's been following the markets for the last few months, how on earth do you time it? It's just, it's crazy. Is this, is this the bottom? Is it, we're only 15% down on where we were a couple of years ago at the end of a decade bull run. It doesn't make a lot of sense. So again, we tend to not know timing, and just so we go into following other people. So having a strategy that just works regardless of timing is one way to get around that. And then a bonus one that I threw in is most of us just can't afford the cycles. The way you learn in anything is to go through cycles of learning, of testing, of failing, evaluating, and going back and doing it again. And in entrepreneurship, we're constantly going through these cycles. But investment, most of the time, we just don't have the capacity to go through a whole bunch of learning cycles. It's why oftentimes investing clubs or investing groups are much more effective, because you can get learning cycles split across lots of people. So those are the 7 obstacles, and if you're not aware of them, then it can, you're going to, it's that old thing of if you've been playing poker for half an hour and you don't know who the patsy at the table is, you're the patsy. So that's the way investing works, unfortunately. You need to understand where the game is rigged. So let's have a look at some historic trends, because this is going to put what the book talks about a little bit into more context. So the first one I want to talk about is real estate investment trusts, REITs. And this was an obscure legal change back in the 1960s. And it was quite interesting. It was designed because up until that point, the only people that could buy big commercial properties were very wealthy people. And so what the government of the US said was, look, we want to be able to allow individuals to benefit from some of the growth in commercial real estate. And so they created something, REITs, which is basically like fractional ownership. And what it did was it created liquidity. It took a very illiquid product, in this case, commercial real estate, and it gave it some liquidity. People could buy and sell fractions of that business. Now, it actually took a couple of years for people to figure out what this was all about. But when it took off massively. And today it's a $2 trillion industry. And it's by making something that was illiquid, liquid. So another trend that's definitely worth looking at was 20 years later. And these things tend to seem to go every 20 years. So in the early 80s, you had Milken, who realized that junk bonds were being undervalued by the market and were a fantastic way of getting capital into corporations and allowing them to grow. Inc. magazine described junk bonds, what we now call high yield bonds, as the single biggest innovation in corporate America. And what it did was it allowed investors a different route to get money into corporations. It allowed corporations to invest in infrastructure projects that they would never have been able to get that capital to do otherwise. So a lot of the internet was built, like the fiber, the cable fibers that carry the internet was all built on junk bonds. Most planes, a lot of airlines were built on junk bonds, a lot of infrastructure projects. So they were a hugely valuable tool because they created a way to get investor capital into companies in a way that allowed them to grow where previously they hadn't been able to. 20 years after that, we had the dot-com boom, so internet growth. And this is where the world realized that investors will pay a huge premium for fast growth. Now, sometimes, and it kind of, this still applies today, people will pay a premium for fast growth. Sometimes we want profit. Profit kind of goes in and out of fashion. In the 2000s, late 90s, early 2000s, profit really didn't matter. It was growth in eyeballs or clicks or whatever you could get to grow at that point was what investors were focused on. And investors are focused on growth because growth allows exponential returns. 20 years after that, we come up to today. And I think the trend that we're going to see for the next decade is really this ESG. And people have been talking about ESG for years and years. I've been talking about it, social entrepreneurship, for over a decade. But really in the last year, I think the whole investing world has switched around to this. You've seen companies like BlackRock, which controls $7 trillion, saying they will only invest in ESG stocks. You've got sovereign wealth funds saying they will only invest in ESG stocks. So I think there's a real sea change for the better. And I think there's been, I think there's a shift. I see what's interesting is there's been this disconnect because at a small business level, entrepreneurs have known for decades that you need to have a bigger cause if you want to motivate your staff and your clients to get behind and get passionate about what you do. Investors were completely detached from that. But I think there's definitely an aligning. There's still a long way to go, but there is definitely an aligning. So those are four really interesting trends. And it kind of begs the question, what about if we could combine those factors? So you've got liquidity of a previously illiquid product, you've got investment into business, you've got that growth, and you've got a net positive impact, and obviously to get above market returns, which is what we're all looking for as investors. So let's talk about these three optimum states. Feels like there's probably a book around something like that. Basically, this was the combination, and this was something that I had started looking for as an investor 10 years ago, which was I want to get alpha. I want to get alpha being above market returns. I wanted to have a positive impact in the businesses that I invested in. So I wanted that money to go into those businesses rather than out to other investors. But I also wanted some liquidity. I have got investments, as I'm sure many of you have, in friends' businesses that I invested in. They told me that we were going to exit in 3 to 5 years, and 15 years later, I've still got ownership of these shares that I can't do anything with. So I like liquidity. As an entrepreneur, I see opportunities everywhere, and the opportunity cost of being locked up in my investments is too great for me. So those are the three things that I was looking for. So the requirement for those optimum states are basically 3 Ps. So you need a publicly listed company, because publicly listed companies still give you the best liquidity. You need to preserve cash for investor returns. So if we go back to our idea of growth, the problem with growth is that growth normally takes a lot of cash. But you need to find a business that can grow, but without using cash for anything other than investor returns. And in order to do that, you need to have prolific products. So let's have a look at a couple of ones that are in this space. So interestingly enough, Bank of America came out and said picking stocks with high dividend yields was the best strategy for the last decade. They don't necessarily recommend that for the next decade, but that was what their recognition was. So companies that had enough capital to be able to give a yield back to their investors. And then on the other side of that, you look at these growth companies. Now, again, all of these are publicly listed companies. All of these have massive liquidity. Most of these companies, although they've grown, have not used cash for growth. Amazon's a bit of an outlier in terms of that, but Amazon can turn on or off the switch as they want. But Facebook, Alphabet, Apple, if anything, they've been criticized over the last few years for accumulating so much cash because their product is digital, and they've been able to grow without burning too much cash. And you can see that the returns have been incredible for companies that are the size that they are. Now, on a slightly smaller scale, what we've tried to do is take the ideas that I just talked through and turn that into our own business. So this is really kind of agglomeration. Now, agglomeration, as Jeremy said at the beginning, we wrote the book. We did the whole agglomeration model in order to help small businesses, but it also allowed us to create this public entity, publicly listed company, which became a valuable tool for investors. Now, so we are a PLC. By nature of a few things, we're very liquid for a small PLC. We do preserve cash for investors. We don't use cash to do our acquisitions for our growth. We use stock or our own bonds. And we have a prolific product. There's no shortage of great small businesses out there that will join your group if you give them the control so that they keep control. And that's really the heart of agglomeration. I'm not going to talk too much about agglomeration. Jeremy did a presentation last week on it. If you're not familiar with it, you can read the book or you can look at last week's webinar. So I'm not going to go into it too much, but you can see it ticks a lot of those boxes. So the one that we're running at the moment is MBH. It's been, we're just about to announce our first year's numbers, but it's been an incredible first year. We've got some incredible small businesses in the group, got an incredible pipeline. I'm going to stop saying incredible, but really amazing companies. And I was actually on a call with all of them today, looking at how they're working together. And it's just, yeah, it's really inspiring to be a part of this group of businesses. So I obviously think there's one course of action when you see an opportunity like this. So I will very quickly just go through something, an idea that I've been talking about at a few of my public speeches, is that, yeah, you can have a great business concept, but you also need to have pioneers. Now, for a company like MBH, our pioneers, first and foremost, were the companies that come and join us. Ultimately, they're putting their faith in us, but also the early investors are those pioneers as well. So this is a scene from California Gold Rush. The last business trip I did was out to California a couple of months ago. It does seem like a lifetime ago. Interestingly enough, those pioneers that went out to California, some of them made money in gold, but actually the ones that ended up taking a stake in California and building the state of California ended up doing much, much better. So owning a stake in a pioneering concept turns out to be very, very lucrative. And in fact, if you look at Hollywood and Silicon Valley, they're two of the most incredible money creators in the history of mankind. And they both came out of that California dream, that vision, and those pioneers. Closer to home for me, this is Singapore. This is Stanford Raffles. 30 years before the Californian Gold Rush, young Stanford Raffles was sent to Singapore to turn this into a trading post. What he realized was the Dutch had already beaten him to Southeast Asia, and they controlled most of the ports. So he decided to compete with those different ports by making Singapore a free trading zone. Within a year, he had taken, he was doing more business than the whole of Southeast Asia put together. But what's interesting, Singapore has then grown. It's now one of the most successful small nation states in the world. And again, entrepreneurs flock here, they take a stake here, and the ones that took a stake early in Singapore's growth have become incredibly, incredibly wealthy, as one of the highest proportions of billionaires in the world. So it's there's definitely a message there. Doesn't necessarily need to be the pioneer that starts this thing, but getting in early. And what we need, what any of these ideas need, is people that resonate with the values, resonate with the idea, and then go out and spread that word to others. And if any of you have seen Derek Sivers, who also used to live here in Singapore, on how to start a movement, it's not so much those original pioneers that are brave, it's the ones that come in just after and that support it, get involved, and then go out and advocate for it, that are the bravest, but also get well rewarded. So if you want to get involved, just quickly run through this. There's a very good book you should read, which you'll get a copy of. Do your own due diligence, obviously. Then I'd recommend just buying some stock on market if you're interested. And even if you don't want to put a large amount in, MBH is a good stock. If you're just interested in learning about investing, we're probably more transparent as a PLC than any other PLC out there. We put a lot of time and effort into communicating with our investors so that we can share exactly what's happening. And if you are interested, if you go and have a look at our MBH site, LinkedIn or Twitter, we share a lot of content about the companies in the group, interviews, that sort of stuff. So it's a great way to learn about companies. If you're really sold on the idea and you want to take a slightly bigger stake, you can acquire stock off market. You typically get a little bit of a discount or a little bit of a special offer. Contact myself or Jeremy directly for that. We have a relatively small but tight group of investors that have done that, and they have a small community. Obviously, you get growth. The intention is always that MBH would be a dividend stock where possible. I can't say too much about that because we're announcing our numbers in a couple of days. But by being part of that group of investors, then you kind of tap into myself and Jeremy's inner circle, and we obviously get a bunch of deals, not all are right for MBH, but we share them with investors that have come through that. And hopefully that'll take you from frustrated investor to entrepreneurial investor. I just want to finish up with these two gentlemen. And this is kind of really what drives myself and Jeremy behind this whole thing, is that we genuinely believe that it's entrepreneurs that are the biggest change makers in the world. If you look at anything cool that's happening in philanthropy right now, it's all being driven by entrepreneurs. And basically they're taking the entrepreneurial approach of fixing problems, and they're using their resources that they've built up over the past few decades to fix those problems, conspiracy theories aside. Yeah, if we can help more entrepreneurs to start thinking more philanthropically at an earlier age because they've joined an agglomeration, then I think that helps everyone. And that's certainly what drives us. And if you like this kind of stuff, I just want to finish up with a couple of other things that might be of interest to you. So on May the 6th, which is a week or so away, we have another webinar slightly earlier. So I apologize for those that it's very early in the morning. Mark Matthews is the head of research for Julius Baer. He's a fantastic presenter. He has unparalleled access to research about what's happening in the economy. Some of his views are quite controversial, but we're going to get him to present, and that will be a really good presentation. Completely free to join. Wayne will set give you the sign up link in the somehow I'll get you that sign up link. The other thing is a project I've been working on for about 6 months, which is a 3-day online summit for investors on May the 11th to the 13th. We've got about 20 speakers lined up for that. I've been recording them for the last few months. This isn't really talking about kind of what's happening in today's market. This is really bigger long-term trends in investing over the next 10 years. But yeah, really, really good content. Again, it's completely free. So just go to ei-summit.com and sign up for that. There's some really, really good speakers in that I strongly recommend. And with that, I will welcome back Jeremy.
Hey, yeah, thanks for that. That was really helpful. I put lots of meat on the bone. And while you've been chatting, there's been loads of questions. So I think what I'll do is I'll ask the questions and you answer them. And then if I think I could chip in anything on the end of the answer, I'll add to it. But so the first one is from Jennifer. Great presentation topic, thanks. Regarding MBH's acquisition criteria, what do you ideally look for in a business and a business owner? And also, why did you issue a bond to acquire Robinson's Caravans? In brackets, stock price, question mark, close brackets. So three things there really: acquisition criteria, what do you look for in the business and the owner, and the bond.
Yeah, so what we're looking for, I've now got massive echo, hang on.
You are logged in twice. I can see you twice. I don't know if you can, one of your profiles, the other one.
Okay, now I've lost my ears. Anyway, yeah, so what we're looking for, ideal scenario is we kind of have a target of companies that we're looking for. The biggest criteria really is that they're not for sale. We're not looking for small businesses where the founder wants to exit. We're looking for companies where the founder still wants to grow, still wants to take their company, keep their culture, all of those kind of things. Ideally, what we're looking for is companies that are doing around $1 million in EBIT, but we can be flexible. 1 to 10 million tends to be sort of our sweet spot, and ideally they're debt free. But basically, we'll take a look at any deals. A lot of it's really about finding the culture fit and companies that are going to be long term. We're a buy and hold strategy, so we really want companies that, if you mentioned Robinson's Caravan, that's a 53-year-old company, and we're pretty sure it's still going to be selling caravans in 53 years time, or maybe flying caravans. But yeah, we like companies that kind of have that longevity behind them.
Fantastic.
So the question on bonds, so typically the way that we structure deals for companies coming in is they come in for a little bit of consideration up front, and then it's a perpetual earn in. So the more they contribute over time, the more shares in the company they earn. So there's a big incentive for companies in the group to perform. Now, for the initial shares that we issue, we will only ever issue shares that are accretive in nature. That means that the existing shareholders are not being diluted, or the percentage-wise they're being diluted, but their earnings per share goes up. One thing we can do to enhance this is by also issuing our own bond. Now, our own bond gives us a couple of options. Firstly, it provides downside protection for the business owner. If they would like a little bit of mitigation around bouncing stock price, they can have some of that consideration in stock. Actually, Robinson's was a slightly different scenario because the founder had retired the year before. He didn't really want the volatility that can come with shares, and so we did the deal in stock. But I think you'll see a number of deals in the future that are kind of a percentage of stock and bonds.
Yeah, I think the interesting thing with Robinson's, he'd retired, but I mean the management had been in there for the last 10 years running it, so he'd always been a bit of a figurehead for it because he was Mr. Robinson. and the new management had been in there for quite some time, and he'd been looking for a way to transition, and this was quite a good way for him to transition, wasn't it, in terms of bonds for him and the share earning scheme for the management team. So it kind of ticked a couple of boxes there. Next question is, I'm 17 and operating, I thought that said an escort business, sorry, an esports business. But, at 17, I was going to be confused. So at 17, I'm operating an esport business for 3 years in Istanbul. In Turkey, economical situation is not good. Is it an opportunity for European investors? And is my age a disadvantage to get investment?
Interestingly enough, I have one of the videos that I do on the EI Summit is with a fellow Turk, Adnan, who runs 3 esports cafes in Turkey. So I'd strongly recommend that you jump on and listen to that. Look, esports is a very hot topic right now, and I don't think that's going to go away. I think it's a really interesting space. I sit on the board of advisors for Kinguin, which is a Polish e-gaming company with about 7 million clients. So I like the space a lot. I think when you're 17, the key thing is to surround yourself by people you can learn from. So try and get some mentors. But it's definitely it's an exciting space right now for sure.
But yeah, and I would just add to that. Yeah, I'm sure you could get investors from European Union. The key with any business, I think, is having some traction before you go looking for the money. So if you can demonstrate you have revenue, you have customers, then it's always easier to get access to capital and things like that. Next question is M8H listed in the US?
Yeah, so it should be. So it's listed on the Xetra, which is a global electronic trading platform. Basically what happens if you're a small cap, so if you're below 100 million market cap, as we currently are, a lot of the bigger trading houses won't actually carry you unless enough of their customers whinge to them about it. So if we're not currently on your trading platform, give them a nudge and give us a nudge. Let us know which platform. But yeah, it's a global platform. Anyone in the world should be able to trade M8H stock.
The next one is, why is the market pricing you at 46 cents? It says after showing profit for a few years, but of course we've only been listed for a year. What's the market seeing that we're not able to see?
So I have to be a little bit careful talking about share price as a CEO of a public company. Maybe Jeremy, do you want to answer that?
I can answer that. Yeah, we haven't shown profit for a few years, I think is the key. We listed the company back in November 2018, but that annual report was really just a couple of months of trading from the first 2 companies that had joined the group. So the report that comes out, is it Friday this week or Thursday this week? It's pretty soon, isn't it?
Thursday, yeah.
Yeah, you are allowed to say that, aren't you? So yeah, on Thursday. On Thursday, the annual report comes out. That will actually be the first annual report for the company with, a decent group of companies in there. And actually, one of the key things that will happen then, once a dividend has been announced and once the audit report is published, which normally happens a little bit after the report, the annual numbers, then Bloomberg and all those other places will populate all of the information. If you go onto something like Bloomberg or Yahoo Finance right now, you'll just see loads of empty boxes where it says things like dividend, earnings per share, all of those kind of key metrics are missing from that stuff. After the first annual report is published, then all of those sites can suck all of that information into their displays and populate it, so then investors can actually see what we're doing. So at the moment, if they look at us, they can't see how many shares are in issue, what the profits were, what the earnings per share are, what the dividend is. And if they go to our prospectus, the prospectus is obviously for that very first couple of companies that were listed. So it's what the market can't see is what we've done in the last 12 months. Now, obviously, if people go through to the investor relations portal on the website, so mbhcorporation.com, and they just go to investor relations and go to press releases, for example. You can read the entire history of everything that the company has done in the last 12 months and the exponential growth that it's seen and the forecasted stuff that's out there. There are also analysts that cover the shares. Now, we're a very small company at the moment, so we do have to pay for analysts to cover us. They don't cover us automatically, but that doesn't affect the impartiality of the information that they publish. We have no control over what they publish. And there are, I think, 3 separate analyst reports out there in the wild that you can read, and they varyingly state that our share price should be somewhere around 185 or 225, depending on which one you read. So clearly at 46 cents, there's a big difference between that price and the potential price for the share. But yeah, I would do your own research, do your own due diligence, have a read, and see if you believe that the market is if you believe the market's mispricing it, then it's a buy. If you want to wait and see, then wait and see. That's probably all I would say on that one. The next question, thanks for the info, and ideally you want business owners who are interested in staying. Yeah. Are you open to staying within your existing markets or new industries? And then she says something very nice about us, and she loves our books, so that's great. We like you too, Jennifer. So, but yeah, would you do you want to stay in your existing markets, or do you want to look in new industries as well? I think is the key question.
So the first part of the question was, yeah, we're looking for business owners that stay on, but equally what we're seeing more and more of is where the business owner has already stepped down, a little bit like the Robinsons deal, and the management is coming to us saying, we want to bring this into the group. For us, we need to know that there's somebody capable running the business. That's the key criteria. In terms of industries, no, actually we like more industries. The whole idea, we want to be geographically diverse, although we tend to focus on English language, English rule of law. Right now, we're very heavily in the UK, but in the pipeline, we've got companies in the US, Canada, Australia, more in Singapore and Hong Kong, New Zealand. So geographic diversity is one thing, and then different industries, because different industries give us more protection. Particular industries, we don't want to be, remember I talked right at the beginning about the 7 challenges. We don't want to be trying to time markets. So if we've got multiple industries, we've got that diversification, and therefore we've got protection. Good. So yes, more industries is good.
Yeah, good answer. And then somebody else says which sectors. I guess just anything ethical, yeah. So
I just, my kids talking about witches all day. I was like, what? This is like witches and wizard sectors. Yeah, no, pretty much anything. We tend to focus on service-based industries, but no, we've got stuff coming through the pipeline in food and beverage, in fashion, in luxury, in travel. So yeah, it's we're open to looking at anything.
Yeah. So somebody else said, very valuable webinar. I may have missed this, but why do you not provide growth resources to portfolio companies? For example, digital performance marketing and culture and people strategy. I've always looked to invest more than just money into companies because I believe it provides a higher probability.
Yeah, so look, it's a good question. It's a common question. Basically, what we do is we say, look, if you're a company joining us, there's a wealth of resources amongst your peers. So there's companies in the group that have fantastic IT services. There's company in the group that are focused, have got talent in HR. What we don't do is try and give a top-down view. The challenge is, and this is really key, is that the minute we start thinking we know better than the companies we bring in, the minute we think that our solution is a better solution than theirs, the dynamic shifts. And this is where you kind of go into the typical roll up and list model where, maybe you consolidate the finance function. Well, we've got companies in the group where the CFO is the brother-in-law of the person running it, and if we fired that brother-in-law in order to save some costs and consolidate the finance function, we would destroy trust, and you know, the whole model starts to fall apart. So it's a fine line, but basically what we say is, look, don't look to the holding company to provide these resources. Look to the other companies in the group, and that way it's a peer-to-peer relationship, and it kind of gets away from thinking that we know best. And look, there's companies, you know, it's very easy when you look at a company to think you know how you could make that company better. But we're not working with startups. These are companies that have, you know, on average, they're more than 20 years old. You know, they're very successful. They're spitting off cash. These are good companies. And basically, we don't need them to suddenly transform into the best companies. We're quite happy with them going along and growing at their own pace, because that's what works for them. So it seems a little bit counterintuitive, but because of it, because of that autonomy that business owners get to make their own decisions about how they work with others in the group, well, that's how we get such a good flow of deals.
Yeah, I think a good analogy would be that, you know, the businesses that used to sell out to Warren Buffett, because Warren was famous for giving them, you know, not the best price, but a fair price, but then also staying out their way, letting them run the business. And you know, I think that's what people are looking for, is they want that ability to continue to grow and develop the business in the way that they see fit. And the other thing I would say is that they're heavily incentivized around increasing their profits. They get this earning structure that can be, it can massively increase their wealth if they add a bit more profit to their business each year. So when they get in a room and they collaborate and they come up with ideas together, those ideas tend to get implemented and tend to get exploited to their maximum in order to increase those profits. And you know, my experience of merging companies over the last 20 years is that if it's your idea, it's a really terrible idea, and if it's their idea, it's the best idea ever. So make it their idea and let them implement it, and you tend to get a much better transaction. So I've got one here, which is just a really common question. Why would a business owner do a no cash deal when they can sell to PE for 6 to 10 times in cash? US PE firms have billions of dry powder they can't deploy.
That's one of my favorite topics. First of all, most of the companies that we're looking at are too small for private equity. Private equity tends to start looking at a sort of 100 million to 200 million and above in terms of revenue, whereas we're probably sort of 100 million below revenue. But fundamentally, the founders that we want to work with are not the people that would ever sell to private equity. Yeah, these are people that have spent 20 years building their companies, and they don't want to have somebody come in, lever them up with as much debt as the business can support, fire half the staff. You know, this is their legacy, and they want to keep the control. They like their culture, they like their team, they like their brand. The idea of having a 32-year-old with an MBA come in and tell them how to run their business is a complete anathema to them. So yeah, we don't really lose a lot. If you find companies where they want to exit and they'll go to private equity, and that's fine. But also there's a huge difference between what private equity says they'll pay and what they actually pay. We have quite a few people come to us that private equity promised them huge multiples, and then got them sort of 9-12 months down the process, and then did a bait and switch. Yeah, they just walked away from those deals. So private equity has a very different approach. They tend not to be very entrepreneur friendly. So yeah, we don't really see ourselves as competing with those guys.
Yeah, I mean, I think if you want to sell, sure, it's a great, you know, it can be a great option. Like Callum says, they often stiff you right at the last minute, but if you want out, they'll definitely give you the way out. Even if they say they want you to stick around, you'll be out. But most of the people we deal with tend to be, you know, still in love with their business on some level and want to see it, you know, go on and be successful and retain its brand, and you know, just be the best it can be. Somebody saying, what kind of transaction? Is it cash or stock? Yeah, it's all stock. Jennifer saying, if it's appropriate for this call, can you share how accelerated venture capital can help MBH or other entities?
Yeah, sure. So this is, I haven't talked about it on this presentation, but it's something that we kind of only really went public with in the book. So I do talk about it in the book. Basically, the idea was to create our own, it's at arm's length, but it would be kind of a venture capital firm that only invested into companies that were going to join an agglomeration. So imagine that you've got your 20-year-old aircon maintenance company, and they've got a client that wants to take them into a whole new project, but they'll need a capital investment in order to service this big project. Well, MBH is not really designed to inject capital into companies. It gives them scale, it gives them liquidity, but we didn't actually invest capital into the business. And so accelerated venture capital is a arm's length venture capital arm that would invest capital into the business basically in the morning, and in the afternoon they get acquired by MBH. And what that means for the small business is they now get all the advantages of going public, but they also have a war chest which they can scale up and resource up. For MBH, it's fantastic because it means that we've now got these good, profitable companies coming in that also have a really fat balance sheet and have the ability to scale. And then for the venture capital arm, in effect, they invest in the smaller liquid company in the morning, and in the afternoon, they got their exit. So as soon as there's the share price goes up, they can start to exit that position, take that funds out and invest it in the next deal. And so they can kind of compound. So it's a really interesting idea. It doesn't, it wouldn't work in any other scenario than when you've got a liquid, fast growing entity like this. We've been so focused in the last year, although we've set this up, we've been so focused in the last year of just building MBH. We haven't done a lot of work on actually fundraising in AVC. It's got a few million in there, but not much. The aim is to kind of raise another 100, 200 million into that venture capital arm so that we can then go to market and say to companies that want to join us, hey, look, not only can you join us, but we'll invest some capital in you to help you grow as well. So it's really, it kind of takes the whole agglomeration model and puts it on steroids. But we haven't really had a chance to give it the full treatment yet.
Next one, what if, and we haven't got time for many more, but I'll try and whiz through these ones. What if a company loses everything through COVID-19?
So yeah, it's an interesting question. I mean, myself and Jeremy have been being asked for 5 years, what happens if there's another global financial crisis? And we always said, we'd rather be in a group of companies than out trying to figure this stuff out on their own. And having watched the way the companies in our group have worked together and shared ideas and best practices, that's been borne out amazingly. So look, I think we have some protections in place for all shareholders. When a company comes into the group, we're not betting on it's going to have an amazing next quarter or even an amazing next year. We're looking at it as long-term investment. However, if that company got into trouble in the first year, and for example, and they weren't going to survive, we actually have an unwind clause. So theoretically, if a company falls below 80% of their last year's EBIT, we reserve the right to unwind that company. And we have actually unwound one company recently. And it's very straightforward. Basically, they give back the shares, we give them back their shares, and we each go our separate ways because we haven't tried to merge all the systems and cultures. It's a very easy thing to do. There's no cost to the shareholders. And it's the ultimate protection. It means that, we can do these deals. Obviously, we hope they're going to work out, but in the event that they don't work out, the existing shareholders are all protected.
Yeah, I think this is really powerful. There's two really key points to this as well. It's a one-way agreement. So it's MBH's choice. The company can't unwind under any circumstances, but MBH has the choice to unwind if they don't perform. There's a few other criteria that they have in there that would also trigger the unwind clause, but the typical one is this 80% of EBIT. But you think about a traditional roll-up. If you borrow a ton of money, if you do it the PE firm way, you go out and you borrow a ton of money, you give it to that business owner. They're sitting there. You may have retained them for the next couple of years on a consulting agreement, but fundamentally they've got the money in the bank. If that business falls off a cliff, you've got a really big problem. You've got to pay that money back. You've got all these obligations, which then potentially fall on the shoulders of the other members of the group. Whereas we have this luxury that we can simply unwind and completely de-risk it for investors. So it really is quite a powerful structure.
I think also what you're seeing now is the companies in the group, the founders really dig deep because they own a stake in the future of each other's companies, and so they do work hard together and pull through in a way that if you've already banked millions. There was a company in our pipeline where the guy is in his 60s. He was going to join us. This started to hit and he just went, you know what, this is too hard. I don't want to go through this again. And just wound down the business. And I think had he been in the group, he wouldn't have done that. He would have pushed harder, but he wasn't in the group yet, and it was just too hard to go through. So the companies in the group work really, really hard to make sure, because it's in their interests to do so.
Yeah. Somebody else here wants the webinar link from the agglomeration one. If you go onto the Harbour Club YouTube channel, it's called something like roll-ups and consolidation strategies or something like that. And it's from last week. It's from last Monday. So if you just have a look at the videos posted in the last week, and you should see that one there. It's quite long. It's about an hour and a half. So should stand out. Is the money raised to support existing businesses or acquire new companies?
Is this still talking about AVC, or is this?
No, I think this might be talking about when you were saying take part. When you buy shares in the open market, you're just buying them from someone else, basically, aren't you?
Yeah. So we have. It's interesting. We have two pipelines. We've got a huge pipeline of companies that are straightforward companies that can come in and we can just transact very easily. We have another pipeline of companies where, for whatever reason, we need to tidy up their balance sheet before they come in. So maybe they've got some debt on the books, or maybe there's a minority shareholder that we need to buy out. So oftentimes, if we raise some capital off market, we'll use that to just allows us to do more transactions that we might not be able to do otherwise.
Cool. And then we've got a question here about Harbour Club, so I'll answer this one, which is, can you touch on Harbour Club strategies in Canada? Loads of info, case studies out there for UK, US. Yeah, because we run events in the UK and the US, the content tends to centre quite a bit around the UK and the US, but we have got quite a few Canadian delegates. In fact, our US office is in Canada, so not in the US at all. If you want to reach out to Monty, so Monty at harbourclubusa.com, who is in Canada. We actually have a Canada group that gets together quite regularly on Zoom and talks about stuff, and they're very active over there. So yeah, if you join, there is quite a little Canadian community building up over there. So market price, that was the repeated question. What market you quoted on? It's the Xetra or Xetra market in Germany. It's the main market in Frankfurt. So if you type in M8H or MBH Corporation PLC into the search box, you should be able to find us. Sometimes the M8H has a .de or a .gr after it if you're looking on something like Bloomberg. But yeah, have a little mooch around there. Has COVID-19 changed your approach to acquisitions?
Yeah, wear a mask now.
Yeah, not flying too.
Not really. I mean, we always do due diligence on the companies. You make sure they're all audited. I think there's probably a little bit more focus on is how badly has the industry been affected, and is this a company that can get through that? I mean, the interesting thing about that is a lot of the companies that we're currently talking to in the pipeline that we believe will be strong companies in the group. Part of the reason that they want to get into the group quickly is that they've got this opportunity to consolidate in their industry while other companies are struggling, and they want to do it as part of MBH, so build verticals underneath them. So look, whenever there's challenges, and it always creates opportunities as well. So yeah, I think definitely will have an impact, but I think longer term it'll be quite a positive thing for us.
Cool. Aram, you're asking questions about an agglomeration. If you want to just reach out to Wayne and get in touch with either myself or Callum, we'll have a quick follow up after this. Otherwise, we'll run out of time. What happens when a company bought into MBH goes under due to COVID-19? So as Callum was saying, we have this unwind clause, which gives us the ultimate kind of get out of jail free card when it comes to under performance. Luckily, I mean, most of the deals that we've done are in the UK and New Zealand, where they both have, the government will pick up the tab for your staff if you want to furlough staff. They have grants, they have subsidies. So actually, and the businesses that we're in a lot of cases are able to continue in some capacity as well. So we're quite lucky with the industries and the locations that we're in. The company that we had to unwind had significant operations in Southeast Asia, where they didn't have those furloughing opportunities and various other things. So yeah, it does that. That's, I guess, as a change in approach right now. If someone takes their company public under MBH, then would they move on to an agreed salary per year as they no longer be able to take out the profits?
So yeah, but basically when a company comes in, they set their own salary, but we do need to make sure it's market rate. So because companies, the more profit they contribute to the holding company, the more shares they earn. Actually, the tendency for most small businesses is to lower your salary, and so you get more shares. We need to be able to demonstrate to the market that they're paying themselves a market rate. So normally what happens is that when the founder comes in, they'll normalize their salary. Most founders tend to pay themselves a low salary and take dividends, so it tends to get normalized when it comes in, but they choose. It's up to them.
Cool. Somebody else asking about the trading platform. It's the Xetra or Xetra, Xetra. It's, like I say, the main market in Frankfurt. Will you do more bond acquisitions? Yes, I guess is the answer to that. It will certainly always be a feature, I think, in acquisitions, because it's quite clever. And that's a repeated question. I don't think you currently have IT services in MBH. Why? So, many reasons why. Yeah, I mean, we've got loads of companies in the pipeline, I think, from IT services and managed services and things around IT. So yeah, Terry, we'd love to talk to more IT services if that's an offer. Just check TD Ameritrade doesn't have you. Yeah, Interactive Brokers or Saxo definitely do. So they're always a good bet. I know it's impossible to time things, but what are the main opportunities for acquisitions given current events? What were previously healthy businesses that are in trouble now? And would you recommend? Yeah, so I guess just to field that one, we don't really look for opportunistic or distressed type deals for MBH. So most of the businesses in the group have been through a couple of economic cycles already. So we're looking for companies that can weather these kind of economic cycles. This one is slightly different. It's more of a natural disaster style of crisis rather than a traditional recession, which tends to be, driven by one sector getting into trouble and then having contagion into other sectors. So this is a very different recession to other recessions, but yeah, it's really about finding the ones that have a business model that's sustainable through the crisis, and that won't be too badly affected afterwards. What if the founder decides to retire a year into the listing? Is there a clause that says they can't do that? And if the owner gets seriously ill, would they have to step down as well? So,
Yeah, most of the owners, well, it's part of a conversation that we have on the way in. So, as you've heard, some people are just that they've retired already. Most of the owners that we work with are still, they've still got a few good years ahead of them. And it's kind of up to, there's a few options when it comes to succession planning. Some of them are already kind of grooming up their team behind them to take over. In other cases, what we recommend is that if they want to retire, that they do an acquisition and they bring the founder of the company they acquire on board to run both companies. But also within the group, you probably find that there's entrepreneurs in the group that be willing to take over the running of one of those companies because they then get the upside of the bonus shares. So we have a few opportunities around that succession planning, which in of itself is quite a valuable part of the agglomeration model because there's not a lot of other options out there for succession planning.
Cool. Do you audit each company's financials by independent auditor before joining the group? Are those audit reports available anywhere?
We do audit them. No, I don't think they are available.
Yeah, they're not available is the answer. I mean, you can pull certain records from certain central repositories of financial information, like Companies House and things like that. But there is an annual report, obviously published by the public company, which is a legal requirement to disclose. And that within that, there's an auditor's report, and the auditor audits the audits. It is fairly diligently scrutinized. But yes, all of the subsidiary companies are audited, and then the main company is audited, and the audits are audited by an auditor. That's a lot of using of the word audit. Christ. Yeah, there's quite a lot of questions here, and I think we're kind of running out of time.
We've kind of overrun already.
Yeah, I thought I'd just try and pick a quick one, but you've got things like how liquid is the Zitra market? Hugely liquid. It's probably the fourth most liquid exchange on the planet. So after New York, London, and Hong Kong. It's a very liquid market. We're probably one of the most liquid small caps as well. I mean, having said that, we've got almost no volume today, but we normally have a couple of 100,000 shares a day of volume. I think 2 days before a report, everybody's kind of waiting and seeing, I think, at the moment. But is there anything else? I think we're going to leave these last few questions. I normally do a Instagram live on a Thursday night. So if I do an Instagram live on Thursday night, I might pick through some of the questions that we didn't get to and just answer those separately. Callum, have you got anything else to add before?
If you're going to do Instagram, I might do a TikTok dance and try and answer questions by.
That's a great idea.
Contemporary dance on TikTok.
If you can do it in scrubs, then you'd be like most of the other videos on TikTok at the moment.
No, I think that was good. We kind of segued away from entrepreneurial investing into a lot of the MBA specific questions, but hopefully people still got some ideas and hopefully can improve your investing outlook for the coming year.
So a very good question at the end here. We did promise everybody a free copy of Entrepreneurial Investing. So is there a link that we can share with people to get the book?
Yeah, I assumed Wayne would have sent it around to everyone, but Wayne seems to have disappeared.
Yeah, we'll get Wayne to send it around to everybody that was on the call.
Absolutely, you will definitely get it.
Yeah, awesome. Well, thanks everyone for spending your morning, lunchtime, or evening with us. It's 10 p.m. here in Singapore, so I'm going to go and binge watch Money Heist and then go to bed. I'll see you all soon. Take care.
All right. Thanks, everyone.
Bye-bye.
Bye-bye.